All right, we have arrived at the best time to get started. I have done my vocal exercises. I have checked the PowerPoint to make sure it's functional, and I'm ready to go. So, welcome to today's webinar on an introduction to endowments and planned giving. I'm really excited for this discussion. It covers a lot of territory, way more than you would normally be able to cover in an hour, but we'll move through the material rather quickly. And it is an introductory course, if you will, or webinar, and really isn't diving too deeply into some of these important concepts. We'll save that for another webinar where we maybe choose to parse out endowments and planned giving separately because they are very unique elements themselves, but they blend very well together for an introductory course. So let's get underway. Uh, let's start, though, if you don't mind, with just a little bit of an inspirational quote for the morning. Uh, Hopefully, everyone needs some inspiration from time to time. And today we have Ralph Waldo Emerson telling us to not go where the path may lead, but go instead where there is no path and leave a trail. And what great wisdom for fundraisers who are all attempting to learn, grow, and create, trailblaze a path of their own. So welcome to you all, and hope you enjoyed the webinar today. My name is Chris Looney. I am currently the founder and CEO of the 5-Tool Fundraiser, which is a company that is really designed to help inspire, equip, and elevate the work of fundraisers across the country by providing all kinds of education, training, and resources, knowledge, and support. Two of the books that I've written are pretty current and recent, and would encourage you to pick those up if you do have an interest in learning more about fundraising. But also, please check out the website, 5toolfundraiser.com, which does have quite a few resources, up-to-date, current information, changes every day. So do please check it out. For today, we have a lot of ground to cover, as I mentioned. We're going to be covering the definitions of endowments. We're going to talk a little bit about why endowments are so important, how you might choose to start an endowment if you haven't already set one up within your organization. We'll go through some definitions of planned gifts, planned giving, talk about the types of the most common of those planned gifts, and end with some of those benefits, like why it's important, why you really should be focusing on this area of work, and why it could really be transformative to your fundraising efforts going forward. So without further ado, let's move on to that definition of endowment. And in the context of nonprofit work, as you can see here, an endowment is a dedicated source of long-term funding made up of donated gifts that supports the mission and work of a philanthropic organization. Each year, a portion of the endowment is paid out as an annual distribution to fund the organization's work. Any appreciation in excess of this annual distribution is retained in the endowment so it can grow and support future generations. Now, very solid definition. Let's unpack that a little bit. I think importantly, we just need to make sure that we don't confuse endowment with a reserve fund. There are differences typically. For example, a reserve fund would not be invested in the stock market or bonds long term. It would be sort of a cash account reserve, earning some better interest today than it has in the past. But the endowment is meant to have a little more risk to it, but also be geared a little more toward growth and income, kind of like your retirement account when you're actually retired, as opposed to your retirement account when you're 25 years old and just want the thing to rocket to the moon. So we'll go into some of those details a little bit more specifically, but I did want to just keep talking a little more specifically about endowments so that those that are more unfamiliar with them can learn a thing or two. Uh, we have historically seen that endowments are commonly used by the largest and most sophisticated institutions, the universities, the hospitals, but they have and they continue to play a more significant role every day in many more charities of all sizes and are a key element of their financial management strategy and in particular revenue strategy. As I mentioned, not a reserve fund per se. It's something different and separate. I guess the appropriate way to say that is not all reserves are endowment and not all endowments are reserves, but sometimes you can see a commingling of those, but not often. An endowment usually implies that some or all of the use of the endowed assets are restricted in some way. Though it's very common for organizations to all want endowment funds that are unrestricted and can be used for anything the organization deems appropriate, which would be great. The reality is that most endowments have been created by donors who have created restrictions on the use of those funds. Like, for example, my endowed fund can only be used to support the rose garden at the church. Um, that's a real example, and was very restrictive for the church that wanted those endowment funds to be used more broadly. But when that was set up by the donor, and then the donor and the family moved on, passed away, they had very little recourse to change that, and struggled with challenges around how to sort of make the use of those funds more broad than restrictive. But the point is that endowments are often restricted in purpose and not unrestricted to the use of whatever the organization chooses. Also, most endowments are designed to keep the principal intact and to potentially, when there is income, to use that to support the variety of needs of the organization, operations programs, building projects, salary increases, bonuses, whatever it might be. It's not necessarily the case that organizations even use the endowment at all. They just, many of them let it grow and know it's there for a rainy day in case they need it, while other organizations, by virtue of the type of assets and restrictions they have, might be eating into their endowments every year so as not to go bankrupt, if you will, or have to close their doors because of other revenue shortfalls. So you can see that endowments mean different things to different organizations. Some endowments or funds within a larger endowment, and I'll explain this later, might be permanently restricted, which prevents the board or leadership from accessing the funds above a certain threshold or for a certain purpose, while other endowments might be temporarily restricted. We call this often quasi-endowment, which really means that the board and leadership can access those funds for a variety of uses whenever it's needed, sometimes with the objective of paying those funds that they might have borrowed back, sometimes with a requirement to pay those funds back, or sometimes without any requirements at all. Hey, we chose to put the funds in the endowment because we wanted to see the money grow. We hope to see the money grow, but our situation required that we pull that money out of the endowment and put it to good use. You can only do that normally in the situation where it's a quasi-endowment or where it's a temporarily restricted or board restricted endowment fund. And I mentioned that there are endowments, but it's important to understand that the more significant endowments that you're familiar with are not just one sort of big general bank account. They are, in fact, the aggregation of sometimes multiple, sometimes dozens, sometimes thousands of individual funds that have to be managed, where there has to be accounting. And when you add up all of those individual funds, which might be some sort of charitable gift annuity over here, and might be a restricted scholarship fund over there, and then you add them all up, that's when you get your endowment total. So where can we see an example of that? Everywhere, but also very specifically, let's talk about Harvard University. It's interesting that Harvard's endowment has existed for almost as long as the university. The first president actually gave his home to the university to be sold, and that created the Harvard endowment. So we're talking about more than 400 years of an endowment at the university. So not surprising, we would expect it to be large, right? Well, it's more than large. Their endowment, fiscal year 2023, was valued at $50.7 billion. I can remember the day not long ago, I've been doing this work for nearly 30 years. When I started, or a little bit after that, maybe 20 years ago, I can recall that the endowment was $6 billion, and we were like flabbergasted that any organization could have an endowment that large. But here we are, $50.7 billion, okay, in fiscal year 2023. And it supports almost every aspect of Harvard's work. And, the institution of Harvard is very large. It's undergraduate, graduate research, hospital, everything. But it has shared on its website that 5.9 billion is the actual university's annual operating expenses. So you're talking about an endowment valuation that is many, many times the size of the annual budget. And that's really kind of the goal. There's no right or wrong answer in terms of how much should an endowment be relative to an organization's annual budget. But I've heard organizations talk about the need to have an endowment 7 times larger than the annual budget, 10 times larger, 15 times larger, 20 times. It really only gets to some of those multiples when you have an endowment that's already reached 5, 10 times. When you're just starting out, boy, wouldn't it be nice to have an endowment that's 1 times your annual budget? And, that's where you start. You start with baby steps to get to, a Harvard-sized endowment, or an endowment the size relative to the multiple of its annual operating expenses. Now, here's where I was making that point about the aggregation of the endowment. 50.7 billion isn't, their bank account. It's actually the aggregation of 14,000 different funds. And those 14,000 funds can be restricted, unrestricted, but focus on everything from professor salaries to an investment in the law school to buildings and grounds to even upkeep of their fleet of golf carts, you name it. Okay, whatever donors or the university chooses to support and whatever the donor and university together are willing to accept. But importantly, as is the case with most endowments at universities, there's a huge amount of financial aid and scholarship money that is supported by these endowments. And for Harvard, get this, $712 million a year is provided by the endowment in financial aid and scholarships. That ain't bad. And that helps the bottom line of the university dramatically. So they make the point further that 70% of their endowment is directed specifically by donors' intent to programs, departments, or purposes. 70%. That means that only 30% of that $50 billion in some way is unrestricted, where the university would have broad latitude to direct that money to where it deems most important. But they are quick to make the point, and I think it's important to understand that this is sort of the talking point of any organization that has an endowment. The endowment's annual distributions are a critical source of funding for the university, making up more than a third of Harvard's revenue each year. It is the largest single revenue stream for Harvard, okay? And Harvard has a lot of revenue streams. When you think about tuition, when you think about research dollars, all of that, the fact that the endowment makes up such a huge percentage is important. And on our next slide, we kind of talk about that. So the university really sees the endowment as bridging the gap between revenue that is brought in from tuition and research grants and the critical costs associated with the university's teaching and research activities. Now, it's interesting because they say, and this is kind of a bullet point lifted from their website, bridges the gap between revenue that is brought in from tuition and research grants and critical costs. Well, what they don't reference here is fundraising as well, which is, I'm guessing here, north of 100 to 200 million, probably more every year. I should really know that number, but let's say Harvard raises $200 million a year. On a normal fundraising year, it's probably way more. It's probably 400 million, right? But that's part of the revenue stream as well, separate from the endowment proceeds. You can total it all together as the sort of philanthropic contribution, but it's important that we think about separating out endowment proceeds, fundraising revenue, and then earned revenue. Why? Because they all form this three-legged stool of revenue for most organizations. Very few organizations have a fourth or fifth leg to their stools. That would be amazing if every organization did. But let's talk through this for a minute. We're separating ourselves from Harvard now. We're moving on. We're talking about endowment as being one leg of a three-legged stool of revenue. And those legs are endowment earnings, as I mentioned, stool leg one, which for Harvard was about a third. Then you have program revenue or earned revenue. And let's say program revenue for a university is tuition, one area. For a hospital, it would be patient fees, nonprofit hospital, right? It would be patient fees, the cost of care. For earned revenue for, let's say, Homeboy Industries, it would be the revenue generated from their sales of merch from their cafe and other businesses. For Goodwill, Salvation Army, a substantial part of their earned revenue would be from thrift stores and other activities like that, right? And then there's philanthropy, often that other leg of the stool that is so important. And really, all of these revenue streams are meant to combine to contribute to an organization's economic health and viability. Well, what happens if you don't have endowment? Well, two legs of a stool don't really create a great stool, do they? They create two legs, maybe some instability, maybe some wobbling, maybe some difficulty balancing, right? So we're talking about adding endowment. The case for endowment is to help stabilize, help create greater sustainability, viability, all of the things that are here on this slide right here. We have the security of a consistent, long-term, predictable income. That's absolutely the goal of most nonprofits, to create consistent, long-term, predictable income to really drive program support, drive more mission, get to that vision, right? We also believe and know that endowments create longevity for the nonprofit. This is creating greater sustainability, and it's perception and reality. It's reality because there's more money coming in. It's perception because a strong endowment suggests to many donors that there's a strength within the institution, that this is a viable and real thing, that they must be doing something right if they're able to generate endowment from very committed donor sources. And that's really the message that you share with people. We don't have an endowment because we don't believe it would be beneficial to put all of that money toward programs. We have an endowment because our donors helped us create a better tomorrow through their strategy, through their real desire and commitment to our organization, and an understanding that having this backstop, having this fund creates a stronger source of revenues in perpetuity. And I haven't used that word yet. And it's important to share that word perpetuity because that's really what we're talking about. So many organizations without endowment are annually at the risk of disappearing because of a lack of revenue or economic forces that weren't anticipated. But endowment helps because it offers permanent revenue, gives the organization a better sense of permanence. And right there, you see weathering significant economic storms, enhancing stability and prestige, taking the pressure off that annual fund, which, you know, if it doesn't perform as it did last year or better than it did last year, you're sunk, right? There's a backstop there. At times, the endowment becomes a savior when it comes to expanding or investing or building new buildings. It gives independence, oftentimes from sometimes very limited sources of revenue. Let's say you have too much dependence on government support, too much dependence on a single revenue source like corporations or special events. Certainly an endowment can help smooth that out. It gives management greater flexibility for the just day-to-day functioning of the business of a nonprofit. It's inspiring to people to make their own gifts to endowment or in other areas. I think it helps a donor perpetuate their own interest in a particular aspect of the organization or the organization as a whole. It really allows them to leave a legacy and to assure the success of certain programs that they value. And, it's fun to be able to talk to donors about the opportunity that establishing a personal endowed named fund does to endow someone's annual gift when they're no longer able to support the organization because they've since passed on to the next life, right? So what does that mean? Let me break that down. If I'm talking to someone about endowing their annual gift, let's, for example, talk about an individual that routinely gives an organization $5,000 a year in annual support. And you can't lose too many of those types of donors who are your bread and butter, who consistently supporting the organization at some level, $5,000 more or less. That's money that often organizations can just count on and often take for granted. Like, oh, Mr. and Mrs. Smith, they'll never stop giving to us. They love us, right? Well, Mr. and Mrs. Smith are going to die at some point, and so will their gifts. Unless you have that conversation with them about creating an endowment that eventually replaces their annual gift or gives their annual gift when they're no longer able to. So in that situation of $5,000 annual gift, if they're able to traditionally, more typically, create a fund of $100,000 that's permanently endowed and maybe even carries their name on it, so again, the separate accounting, they would be able to, on an annual basis, with a 5% draw, gift that $5,000 each and every year in perpetuity to the organization. And that is a dream. That is a reachable dream that I would encourage all of you to start thinking about, having conversations with your best donors about that possibility. Can we think about ways to? Can we start a conversation about? Can we begin to build a fund that at some point will achieve a size that will end up equaling on an annual basis your annual gift? Do it. It's so important. And you know who those prospects are. Unfortunately, most organizations don't have an endowment. It's just a reality. There are more than 1 million organizations out there, double, triple the size when you talk about religious congregations who aren't officially 501c3s, but who do not also have endowments, who should absolutely have endowments. So there's a heck of a lot of organizations that don't have endowment, and it's just sad. It's unfortunate. It's unnecessary because it's so easy. And I think the problem is, A, there's not many people at some of these smaller organizations to do this kind of work. The hands are short, need more workers to be able to get these things done. But also, it's just a failure of marketing and not maybe having a sense of how easy it is or what to do. One of my next webinars will be sort of plan giving in a box or starting a legacy society in a box. It's the easiest thing in the world, actually, to do if you've got the time and the energy and the volunteer support, maybe, or staff support to help you. But to create an endowment before, over the transom or just by pure luck, you have someone that makes a gift to you and restricts it to endowment, which forces you to do some of these things, you would, as an organization, agree to start an endowment. That's a great place to start. But next, you would really want to put some basic policies in place: gift acceptance, recognition, your usage of endowment policies, and the investment policies, because as I mentioned, most endowments are invested. They're not cash instruments. They're in stocks and bonds and different things that earn income and growth. You would then want to start a basic legacy society, even if you just called it the Legacy Society, which is a listing of names to honor those that have already made estate commitments in the past. And you would put an asterisk next to their name. Those are sort of those that are deceased members. Everyone else is a living member. And those that are living members are those that have documented their decision and commitment to make a gift to you through their estate. easy peasy, right? It's more just tracking and monitoring and updating your lists. Ideally, when you've made that intention and you've done these other steps, you would make a decision to raise some money in cash to kickstart your endowment. Doesn't have to be $1 million, doesn't have to be 10. It could be $100,000, $50,000. You just want to get something started, and start a Kickstarter account or talk to your board about making some nominal gifts to start a legacy society. I think at this point it's important to think about the board members themselves as being the best first target for joining a legacy society, kickstarting this endowment fund. And if we think about all past board members, whether your organization is 5 years old or 50 years old, all former board members are great targets to approach in this particular way for endowment. They have a vested interest, probably a more significant interest, and probably are some of your more tried and true donors as well. But importantly, once you've raised that amount in cash, it's time to advertise. This is not about hiring a plan giving expert or even necessarily having a committee of experts or having attorneys that, those are all good things, but not required. What you really need is advertising. You need to get the word out that you are an organization that prioritizes and believes in the importance of legacy and endowment, and the best way for that to grow and for the organization to reach its goals is for people to name the organization in their wills and estate plans and their trusts, and to think about other ways to support the organization through their estate. And if they fill out the form, that's all that's required. Ideally, you would have some requirements that would ask donors who are joining the Legacy Society to fill out a form that creates some details around their particular estate gift or commitment. And if you took it a step further, you could get documentation for that. That's even better. And some organizations will actually start counting some of these things in their revenue pictures, but most don't. Most just wait and wait and wait, and it's going to take time. These legacy societies don't hit pay dirt overnight, but if you had started this conversation or this effort 20 years ago, 30 years ago, you would be living the dream right now. And so get that dream started and get yourself and your organization to start building this endowment fund and start it off with a legacy society. So importantly, we've talked about legacy society, we've talked about building endowment, and most of these endowments are not built by people writing a $25,000 check or a $100,000 check to you and saying, please put this in endowment. That's often not how endowments are built. The outlier situation or the exception is when an organization runs a very specific endowment campaign to raise $500,000, $1 million, $5 million, whatever it might be for endowment. And in those situations, yes, people do write checks to support endowment, and people do often build endowments and find success in endowment campaigns by counting both cash commitments and estate commitments. And often those endowments are built through plan gifts and plan giving. That's why this blends so well together. So for the last 20 minutes or so, let's talk about plan gifts, which is, by definition, any major gift, believe it or not, a plan gift, any major gift made during one's lifetime or at death or after death as part of a donor's overall financial and or estate planning. So here you thought a planned gift probably was merely an estate commitment, but oh no, a planned gift is really just a very large intentional gift. Okay, it's made with planning and intention. So the planned gift definition is probably way more broad than you had thought. But let me come back and say that the vast majority of planned gifts are estate commitments, are made after someone's life. Well, they're made during someone's life, but they're actually received by the organization after someone has passed on. Okay, so let's push on. And we start with this idea that in fundraising, there's a pyramid of giving. And at the base of this pyramid are the all-important annual gifts, event income, the really base of an organization's support, and probably the most likely area of fundraising for most organizations. The more mature organizations tend to succeed more significantly in the top two categories in major gifts and planned giving. But typically, you don't become a major gift donor. You don't become a planned giving donor without the history of being an annual supporter or an annual event, special event supporter. Okay, so these are building blocks. We often say that the road to a very transformational estate gift, which oftentimes are the largest gifts, begin 20 years before, when someone made their first $100 gift to support some cash call, some annual fund, whatever it might be. And then over the years, their desire and support for the organization increases. Then all of a sudden they find themselves giving annually, and then on top of that, making some major gift, which might support a very specific need, and that major gift might be considered a planned gift or might not. But then at some point, there is an invitation or a move on the part of the donor to make a thoughtful investment, a planned gift, which often requires a little more planning and a little more strategy and thought than just writing a check from their checking account, bank account, whatever, to fund something. Now, there are obviously donors who can write $100,000 checks very easily, and that's a major gift. But I wouldn't necessarily consider that a planned gift if they didn't have to sell assets to give this gift, if they didn't have to create a trust, or they didn't have to do something that requires a little bit more work than just putting money on their credit card or writing a check. But let's talk about some of those typical types of planned gifts, if you don't mind. I mentioned that cash and stock are sometimes, or at least cash is not typically the planned gift mechanism, but it can be. There are situations. Stock is often a planned gift because there is a need to figure out which stock to give: appreciated stock, stock that might be restricted in some way for ownership, and there might be a more complicated transaction required because the stock isn't necessarily liquid, right? So those are considerations. There's property that can be gifted, bequest, charitable gift, annuity. We're going to talk about all of these different elements of planned giving. And today we increasingly find that people are setting up their own private foundations, family foundations, other institutional foundations to generate their giving decisions. And then many donors too are choosing to set up donor advised funds at community foundations or some of the big brokerage houses, which brings an added level and layer of thinking about when to make those gifts and to whom to give those gifts. So with the last few minutes, let's talk a little bit about those individual instruments that are most important. This is an introductory course And so obviously we'd want to dig into what some of these terms mean, because many that are seeking knowledge in an introductory way about planned gifts want to know what planned gifts are. Like, what are you talking about, right? Well, bequest giving, giving through your will or trust, is absolutely the most common form of planned giving. Um, and these bequests, as I mentioned, are made through a will or trust. And these can be even made to a person, but it can often be made, and here's where it's relevant to us, made to a charity, to a nonprofit, a trust, or a foundation. And they can be very simple, as you can imagine, or very complex. If we were running a seminar just on the types of bequests, you'd find that people can make an outright gift of a certain amount of cash from the remainder of their estate. It can come as the first gift or the last gift. It can be the remainder of an estate. It can be a percentage of an estate. There's all kinds of things that you can do. But here's what you should know. Obviously, giving annually is in the half $500 billion range, and of that, nearly 45 billion came from bequests. Okay, so it's not an insignificant form of giving to charity every year, and it's the most significant form of giving to organizations in planned giving. So it's important to, as an organization, have available for your donors the language that they would potentially want to utilize to put support for your organization into their will. Make it easy for donors by providing them the language that they can take to their lawyer, or they can even do themselves when they hire some of these very uh, inexpensive solutions online to create wills and trusts. Okay, so help your donors out by providing them this language, and this is part of your advertising strategy as well. Put that in your newsletter, put this in your annual report, put this language in your stewardship letters, appeals, everything. Help people out. Another very common planned gift is the charitable gift annuity, which, and I'm sorry to go into some very specific language here, but is a contract between a donor and a charity. As the donor, you make this sort of gift to charity using cash, securities, or other assets. And in return, you become eligible to take a partial tax deduction for your donation. And then you receive a fixed stream of income from the charity for the rest of your life. Could be even two annuitants, could be you and your spouse. You can set things up, but it's fixed. And you can even put off receiving some of that income, and that's what we call a deferred gift annuity. But a lot of times these rates that you're receiving a fixed income are suggested by the American Council on Gift Annuities. There is that tax deduction for the present value of the estimated remainder. And that's based on the gift size, life expectancy, income rate, and IRS rate. So it's not simple from that respect, and every organization has to choose whether or not it will offer the opportunity for donors to make charitable gift annuities. You often need a third party to help facilitate these types of gifts. But in the end, they can be extremely beneficial to the organization, and certainly encourage any organization that isn't already doing this to explore the possibilities. It's just another giving mechanism that your organization might be able to offer that could be beneficial to you. So instead of a charitable gift annuity, there's also a charitable remainder trust. And this is an irrevocable trust, okay? Irrevocable trust that generates a potential income stream for you as the donor to the trust, but could be other beneficiaries that could benefit from this income stream, where the remainder of the donated assets, meaning what's left after you die, goes to your favorite charity or charities. That's what is meant by remainder. The remainder goes to the charity after you have taken your income during your lifetime. So this helps you generate income during your lifetime, pursue your goals philanthropically or otherwise, provide for living expenses, whatever it might be, takes care of you while you're living, and then helps the organization by the gift that they receive after you pass on. So there's all kinds of more complicated ways to look at this. There are charitable remainder annuity trusts called CRATs that distribute a fixed annuity amount each year, where additional contributions aren't allowed. There's CRUTs, which are charitable remainder unit trusts that distribute a fixed percentage based on the balance of the trust assets, and it's revalued annually. And in this situation, additional contributions can be made. And this is where you really do need, if you're a donor, to consult your advisors about what's best for you. But again, as the organization, you don't have to be the one responsible for suggesting these things. And oftentimes it doesn't pay to make or offer or dispense legal advice or tax advice or anything like that. What you really want to do is make sure that your donors know these options exist and that you are able to work with their advisors to help create these instruments and mechanisms to support you. We have a charitable lead trust, which is an awesome instrument for people to consider. This is an irrevocable trust, again, that provides financial support to one or more charities for a period of time, and then the remaining assets go to your family. And oftentimes these charitable lead trusts are considered the inverse of the remainder trusts. These lead trusts operate for a set term, which could be for the life of one or more individuals. Payments are made to one or more designated charitable beneficiaries during that period of time. And then at the end of the trust term, the remainder of the trust reverts back to or is supporting or distributed to the beneficiaries that are named. And that provides sort of a stream of income for family members for the term of the trust before the remaining assets are then transferred to one or more charitable organization beneficiaries. And what's interesting is that when you look at CLATs, which are charitable lead annuity trusts, and CLUTs, which are charitable lead unit trusts, they, again, have very specific strategies and goals, and are used for a variety of different reasons. And each donor's situation is unique and needs to be treated as such. And again, it's not for an organization to be out there saying, this seems perfect for you. Again, it's more about allowing prospective donors to understand that these things exist, that they might want to consult their advisor, and that you as an organization would be happy to work with those advisors to figure out how this type of instrument could best support the organization. But there are some even more simple ways to get plan gifts and instruments to use for plan giving. The most simple is your donors' retirement accounts. And before talking about the sort of IRA charitable rollover, let's talk about the strategy of making your organization the first beneficiary, the contingent beneficiary of an IRA, 401k, IRA rollover, Roth, you name it. Okay. That is the simplest way to be the beneficiary. And increasingly, we're finding that donors, high net worth individuals, frequently underutilize or don't utilize their retirement accounts as they might have thought they would when they were younger. They're forced to make mandatory distributions at some point and oftentimes don't need that income, and it um, creates taxable income for them if they don't give it to a charity. But if they do give to a charity, and I believe the amount is $100,000 from their IRA directly to a charity, they can avoid, as a donor, paying tax each and every year on that $100,000 distribution. And that's known as a qualified charitable distribution. And it's a thing of beauty when your donors are being told that they have to take this money, and if they potentially do take it, half of it could require them to give a check to Uncle Sam. And if they don't need that money, why not provide all of it to charity where they are taxed on none of it, and 100% of that money is able to be distributed to an organization. That required minimum distribution is such an important element for high net worth individuals these days. And if you're not advertising, marketing the capacity to support the organization in a significant way through your required minimum distribution, you're missing the boat. Okay, so think about that, advertise for it, and at a minimum, just get people to think about, hey, does it make sense to make XYZ organization, your charity, the beneficiary of a retirement account? Oftentimes, it absolutely does if they know their family members or others they care about are taken care of in other ways. Okay? So I think what we are doing is kind of wrapping up here on the different instruments, but I didn't want to not talk from a basic standpoint about life insurance as a plan giving instrument as well. Life insurance can be an effective and convenient asset for donors to give to charities. And there are so many different methods for making life insurance donations. We don't have time to cover even a short amount of them. But again, the organization doesn't have to be the expert on every single one of these mechanisms. The organization just has to be aware that these opportunities exist, to advertise and market those opportunities to donors, and to encourage these donors to think about how they might want to support your organization through these instruments. So what can people do? Well, interestingly, you can add a charitable giving rider to your life insurance, which has an opportunity at no extra cost to benefit charities for a certain percentage of the life insurance amount that is distributed from a policy. Easy thing to do. There are opportunities to donate the proceeds of a policy directly to an organization. If you don't need that $100,000 life insurance policy to go to your estate and be a taxable part of your estate, why not think about making an organization the beneficiary of it? You can name the charity as the beneficiary. Again, that's a little bit different than donating the policy. You can set up a policy within a trust to strategically manage some of your estate taxes and to avoid some tax issues. Again, there are lots of tax ramifications, and you don't want to be caught offering tax advice, but people with large estates have lots of creative ways, and using life insurance might be one of them to help offset taxes and to also benefit charities. So we need to make sure that we're talking to organizations frequently about this. So before we wrap up, I did want to talk a little bit about motivations. And we talked about endowments, we talked about planned gifts, but there are some very specific motivations why individuals and families choose to make planned gifts. And it's also important to realize that there are some very good ways to identify prospective donors who are most likely to be interested and respond to the information that you might provide them about making a planned gift. But think about your donors and think about the ones that have a desire to create a legacy. They are likely the ones that have been the longest supporters of your organization, the most consistent, sometimes the highest value from a monetary standpoint. And they have a desire to give back. They have a desire to create legacy. They have a desire to see your organization thrive. For many generations, the opportunity to make a planned gift really showcases the donors' focus and prioritization of charity and giving to charity and giving back. And this is a great model that they provide to their children and their grandchildren. Some desperately need income for life, and making a planned gift can provide that, while also understanding that beneficiaries or heirs might be well taken care of. So it's more just about making sure that they're taken care of for life. There are also huge implications from a tax perspective. So you see a quite significant amount of effort being applied to the planned giving arena relative to how it can facilitate estate taxes and limit and minimize estate taxes. They can also help plan for the transfer of a business, pass assets to family at a reduced tax cost, avoid capital gains. So be thinking about how planned giving can be utilized at your organization as a great strategy to help your donors achieve what they want to and need to through their estate plans. Okay? So with the last couple of minutes, let me just open it up for some discussion. Does anyone have any questions that they might have before we want to depart at the top of the hour? Come off mute, ask a question if you'd like.
Chris, this is Angela Gomez. Thank you for such a wonderful webinar. Would it be possible if I could share? Free Wheelchair Mission have made great efforts in the last 2 years to really update as much as possible all the everything that you discussed on our website. I would love to get your input on what we currently have. If I can, after this, send you our links and just get your honest feedback on what we're offering perhaps is great or not so great, and that way we can improve on at least what we have on our website, and then separately, obviously, everything that you've said, having those discussions are by far the most important. Is that okay?
100%, Angela.
Okay,
Yeah, absolutely.
thank you.
I'm a longtime donor to Free Wheelchair Mission. Kid you
Yes.
not, I remember Don starting the organization so many years ago. So I would be thrilled to help in any way. Just reach out to me here. And let's see, there's the information. So, and for any of you, of course, if there are questions, if there's something you want me to look at, or questions after that I can be helpful answering, please do reach out. Part of my strategy through the 5-tool fundraiser is to be a resource, to be a support system to those of you that are doing great work and raising funds to support the missions of your amazing organization. So please do reach out. Angela and everybody else, I see that we're at the 10 o'clock hour, and want everyone to be able to go on to their next meetings and have a great day. So I'll bid you fond farewell. Thank you all for joining, and make sure to look at the website and see what webinars are coming up, because each week we come to you live with a new webinar. So please do join us. In the meantime, God bless you all. Take care. See you soon.